For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Hello everyone, my name is John Locke, and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware, risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Please consider any trades and or results, hypothetical computer simulator trades and or results. They would be believed to be as accurately represented as possible. Keep in mind live results vary from similar results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success, LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. Now, the types of strategies that we generally cover on The Winning Trade are non-subjective, positive theta strategies. That we show you some really nice, powerful examples of those types of trades. But if that's the type of trader you are, you also don't want to throw away opportunities to make a lot of money with a very small investment. And when we start looking at trading that way, we call it professional style income trading. And this is where we increase returns and consistency through trading, sometimes income trades, sometimes directional trades with the flow of the market, and utilizing trader subjectivity with a lot of times high probability trading strategies, sometimes, as you'll see today, just simply a long call. This allows us to make more money more often with less work and less risk. And it's a really fantastic way to trade if you are able to take advantage of the types of opportunities that we're going to talk about taking advantage of today. So the trade structure that we're going to be showing you today is a very simple structure. It's just simply a long call. Our initial risk in our position is going to be $3,600. Our anticipated return on this call is going to be about 200% of our risk, which is about $7,200. Our potential return is unlimited. Our exit loss trigger is going to be 100% or $3,600. So this is the type of trade that we enter, and we're willing to risk the whole amount. Of course, if we're up a certain amount of money and so forth, we may do something to lock in profits. But in general, our initial entry, we're willing to risk that amount because we believe that the trade has a high probability of working out. Now, when we're dealing with our non-subjective, non-directional income trades, we're relying on something like something called statistical probability in order to have a probability estimate. When we start to become professional traders, we start to become competent traders, we start understanding the market, we're looking for opportunity. We're looking for opportunity when there's a high likelihood the market's going to go in a certain direction, and it's going to go an amount that is going to significantly offset the amount of risk you're taking in order to make the trade. So that's one of the cases here. As far as trade setup, if we take a look at our chart, this trade was actually entered on the 15th of March this year. And what we have is we have an uptrending market. We have our 20-day moving average. We have the market settling back into our 20-day moving average in an uptrend. Generally, our anticipation under those conditions is that the market is going to turn around and it's going to bounce higher. We can do our thing. If you're a market outlook member, we talk about timing entries. We talk about price pattern targets to get range expectations and so forth when we are presented with this type of a setup. But this is a fairly high probability the market's not going down here and that it's going to go up, and it's going to go up a significant amount, or at least enough of an amount to make it worthwhile to do a long call. Because one of the things when you do a long call, you actually have to get a bit of price movement. So that's the general setup in theory. Let's take a look at the trade, but before we do, just a reminder to please like and share our videos. We are here to help you become better as traders, and it really helps us to help you if you like and share and comment on our material. Okay, so here we are. We are on March 15th. We showed you the technical setup. So I'm going to come in here and I'm going to do a long call. So options I have with a long call is how many days to expiration might I want to do, what asset, what strike might I want to choose. that all gets back to the technicals, right? So if you're a directional trader, and we coach a lot of directional traders, basically you want to have an idea of how far the market's likely to go. Like if the market's at 51.20, and I don't think it's going to be up over 51.80 in the next 17 days, I wouldn't want to take this trade. If I was really sure that we were going to get a really fast trade, I'd probably want to go something maybe a little bit closer to expiration. If I want to buy myself a little bit of time to be right, I can go a little bit further from expiration. In this particular thing here, I'm probably looking at 1 to 3 days to get back to where we are. I'm going to have a price pattern target. If I set this in here and do something like this, I'm going to have a price pattern target minimally up to about 52.88. If I take a look at my things here, 52.88. Did I say 52.88? That's a big move. So let's, in the context of this, so did I say, yeah, I said 52.88. So a minimal move of 51.90. If things go well and we get a breakout of this pattern that we're going to set in, if we break higher, we're looking at 52.88. If you take a look in here, we're looking at somewhere between 51.80, which is going to give us probably a few $1,000, or 51.88, which is very likely to give us up in the $10,000 range. So I'm risking maybe less than 5,000, significantly less than 5,000 to make maybe $10,000 or more if things play out right. I'm giving myself 17 days for that to happen. Okay, so that is the trade setup. That is the trade that we took. Our total risk is 35.71. So let's move forward. One of the things here is you can choose to exit this or adjust this in multiple different ways. You want to decide that before you get in. So you want to make some sort of a trading plan. You want to know what your trade setup is. You want to know what your expected profit is. You want to know what your losing scenario is. And you want to give it an idea of how much time you want to give yourself. In addition to that, you want to know what your exit strategy is. Whenever we enter something, we always want to know our exit strategy. And also, there's things that you can do sometimes to lock in profits. So let's just see where this went. So here it is, March 15th. Again, this is our price chart set up here. Let me just go to next adjustment. So what happens is we come in here and we go 6 days. And I go all the way to 52.57. So remember, I think I'm topping out somewhere around 52.80. I don't want to take this fine, beautiful entry that I made and this fine, beautiful price pattern target that we're nearing, right? It's a little bit higher than it is, but we're approaching it. So I want to start backing out. I don't want to take that really good decision process and then turn it into crap by just sitting here, letting all the profits go away. So what we're going to do here, we're going to come in, and I sold that call, and I went into what we would call a super bear. So my thought is, if we take a look at our price chart, we came up here into where the area that I believed our price pattern target was going to be. Again, I'm doing this a little bit early because a lot of times the market doesn't go all the way there. And I'm planning for the market, or the SPX here in this case, to back off of that price pattern target. So what I do here is I come in and I throw in this bearish vertical. So let's just go to next adjustment. We'll see what happens. So it's the 21st of March. So I'm using my income trading skills in order to help with my directional trading skills. So what happens here is a little bit of time goes by. We go by another 5 days, and the market does kind of come up into range and top out, and it's starting to pull back a little bit. But one of the things that is happening here is we got our pullback, and it's not pulled back as far as I would necessarily think it's going to pull back. But what I'm doing is I want to take the risk out of some of the risk out of the position now that I kind of have a 50-50 shot. So my point being is, when we were here earlier, I needed the market to go down to be profitable. If the market went up, I would be maybe lose a little bit of my profits. But if the market went down, I had substantially more to make than I would if the market went up, would lose if the market went up. So I liked that. I liked that risk-reward ratio. What happened here is we sat in here for 5 days. The market's really not going down. or at least not going down as much as I like. So what I'm going to do is, now that we move down a little bit, I'm at a kind of a 1-to-1. In other words, if the market continues to go down, I make a certain amount of money. If it goes back, I lose that same amount of money. What I'm going to do is I'm going to take this, I'm going to roll this thing back, and I'll get my risk-reward ratio back to maybe like 1/4 to 3/4. This way, if the market continues going down, it's worth it for me, right? If it reverses, I keep a little bit more cash. So that was the setup there. Let's move to our next adjustment. So what happens is the market bounced a little bit on me here, and I did lose that amount of money. However, I'm also looking at the price chart here, and this is a normal reversal into a support level. It's likely to bounce again. So what I'm doing here is I'm actually increasing my risk a little bit. So I'm going to come in here and I'm going to add what we would call another super bear. So I'm adding that other set of verticals back. So what happened is I had a set of verticals right around this point. The market went up, I took them off and I rolled them up. Now the market went back down again. I think it's going to hold the high level. So I've taken a little bit more risk again. So now I'm in a position here where I don't have a whole lot to lose here. Let's move forward. So here we are. If I jump forward here, it's Monday. I'm getting near the end of the day here. And what's happening is I have two verticals on. I have this vertical on here, which realistically has made almost all of its profits. And I have this vertical here, which is out of the money, which could make profits as the market continues down. So what I'm going to do is I'm going to close out this upper one here. Now I only have a very small amount of money if the market decides it wants to take off or sit still into the end of the day. But if we happen to get the scenario where, sometimes we get some pretty big moves into the end of the day, we happen to get the scenario where I get a substantial down move into the end of the day. This might make up another $2,000 or so. So I like those odds, or I like that risk-reward ratio. I don't think the odds of that happening are very high, but that's what we decided to do. And then from there, I just let this run till the end of the day. What happened for the rest of the day? Really nothing. The market or the SPX went up a little bit, but really not enough to get into to give us any profits here. And we end up with an $8,545 profit on only $3,600 of margin in only 17 days. That is why I love the concepts of looking for opportunity that we teach in our pro membership, so that we can take advantage of these opportunities when they come along, of making very high yields in short periods of time with a very small amount of capital. And that is this episode's winning trade, the professionally traded subjective long call. If you like what you see, I encourage you to come on over to lockeinyoursuccess.com. That's LOCKE inyoursuccess.com, and check out our pro membership, especially if you're liking these subjective trades, where we teach you how to read the market and how to trade it with options. Also, if you're newer, you can check out our Go membership. Our Go membership is where you can discover and follow along with 12 different non-subjective trading strategies as they unfold every week during our weekly options trading for income webinars. Also, while you're there, make sure you check out thewinningtrade.com. That's thewinningtrade.com. There you can find this winning trade. You can find past winning trade. You can find bonus materials for winning trades. And perhaps best of all, make sure you check out our free trading performance podcast, where you can learn to skyrocket your trading, regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see in the next winning trade, please be sure to comment on our videos. I answer all comments and questions personally. Thank you for joining me. I look forward to seeing you on the next winning trade.